Welcome to another Wealth Coffee Chats. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong live for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well. Morning, folks. Out and about today. Hope you're well. Let me know if it's working. Give us a shout out in the chat. Good to see a few of the early birds up and at it already, which is great. A few people on. I forgot to change the name of today's show, but it's kind of the same. Yesterday was Not All Income is Created Equal, and today we're going to talk the same about assets. Not all assets are created equal, or not all assets are as useful at the same time as you might think. Anyway, that might sound a bit cryptic, but welcome along. Great to have you here, folks. Thanks for joining, as always. We'll get up to the show in just a minute, but we'll do the intros while things are warming up and people are jumping on. Jason Whitton's my name. Most of you know that already, though. There's a few of you who are already here in the chat, so great to see you. Jeff, mate, good morning. How you going, mate? Yeah, it's a little bit wet, isn't it? There's some crazy stuff going on all over the place. Big storms in Queensland in December. There's some big storms down in Victoria. Anyway, there you go. Jason, how are you, mate? Good to see you. Alex is there too. Morning, Brad. Chris has popped along as well. Fantastic to see you guys and girls, ladies and gents, boys and girls, who's ever on this morning. Good morning. Welcome. Welcome, welcome. Fantastic to have you here. Thanks for joining. Oh, Brian's there too. Jared thanks, Jared. Thanks for the shout out, mate. Good to see. And Brian, good to see you here. So thanks for popping along, folks. Today, I thought we'd continue our journey. Now, on Monday, I'm pretty sure it was, we talked about the four quadrants, the four pieces of this puzzle we call investing, certainly property investing, and it can apply to other investing as well. But, you know, we're all a little bit mad about property investing. So that's the main thing for us, right? That's the main objective. And the idea that there's income, there's assets, there's taxes and debts, and there's four pieces of this puzzle you have to put together as an investor over time to make sure we navigate correctly, we navigate well in this world of investing. So let's continue with our journey. Yesterday we talked about income. All income is not created equal. That's the name of yesterday's podcast / Wealth Coffee Chat. However, folks, I forgot to change it this morning, but today it's all assets are not created equal. All assets are not created. What do we mean by that? Well, let's dive into that and have a bit of a look at what I mean by that. Let's talk about assets. Yesterday, income. Today, assets. Get involved in the chat here. What are the four things? Let's talk financially. Let's talk mechanically. Let's talk money, wealth, momentum. What are the four things that an asset has to deliver for you, folks? Has to deliver. All right, give it to me. Now, some are more important than others, depending on when and where. But what are the four things that assets? You invest in an asset, it should deliver these four things. It should provide these four things, and depending on where you are in your journey, depending on your age and the assets you're purchasing and so on, these four things will have different importance, but they're all needed, folks. They're all needed, I believe, to become a successful investor and have some assets that you can live off into the future. All right, we've got one answer, which is growth, but there's four answers in there. Brian's there, and someone in the behind the Facebook veil is saying, yep, growth. Brian, appreciate and value. Yeah, absolutely. Well, let's look at this. Let's look at what are the four pieces. Growth, passive income, tax effective. Boom, Jeff. you're there. You've done well. Let's have a look at it. Number one, income. Okay, the asset needs to produce an income, and this is kind of like in the process of understanding what these assets can do. Right, income, then grow and value. All right, growth. Now they're direct benefits. They're direct reasons why you would purchase an asset. Will it provide an income, and will it provide some growth? Now, there's different things you do with different pieces of that puzzle, but boom, there's two really good things. What are the other two things? Well, Chris is onto it, right? Tax effective. Now, this is the thing, right? This is the thing. Our number one expense for most of us in our lives, our number one expense, if you spend 40 to 50 years playing the game of, money, jobs, business, and wealth, folks, what's your number one expense? What's the number one thing that will be on the ledger as the negative? Okay, there's probably two, quite high, but depending on what you buy and how you buy it. But there's very high. The number one thing will be taxes, folks. Taxes, right? Taxes. Then interest. But taxes and interest are two things that are an issue. Now, taxes, you have to learn to minimize and manage taxes. Now, if you can have assets, folks, and we've talked about this, if you can have assets that can help you reduce your tax, if you can have an asset that grows in value and you sell it and you make a gain, or you can refinance and use equity and pay no tax on that, then the tax effective conversation has to be part of this process, right? And investing is not one dimensional. Assets aren't one dimensional, okay? You need income, you need growth, you need them to be tax effective. And last but not least, you need them to be able to be leveraged. What do I mean by leverage? And we're going to talk about that in a minute, okay? Because leveraged is the idea that you can own assets. You can own more assets for less cash in. More assets for less cash in, okay? So let's talk about that, right? Let's talk about that as we go along. What is the use of income? Why do we want income, folks, as we go along? Well, most of us want our income to have a passive income in the future that's reliable. A passive income of 100K, 200K. Income is important. That income, that's a medium to long-term goal, right? In the short term, you want the income to provide it cover the costs, okay? Now, the cost of owning, let's say, residential real estate or any asset can be a cash drain. You want the income that asset produces to be able to, in one way, shape, or form, cover its own costs or significantly contribute to covering those costs, depending on how you're structured, especially with tax back and stuff like that. So you want a passive income in the future. You want it to cover its own costs. And short term, folks, you want it to add to your ability to service more lending, your serviceability, okay? That's what the income's for. Now, depending on where you are in the journey of investing, well, the income might be all about adding serviceability and covering its own costs. And the passive income that you can live off, that's for later, okay? That's for later. Yep, other people's money indeed, Chris. And you've got that version of the world, other people's money, other people's time, other people's knowledge, other people's connections and relationships. How do you get leverage? I love it. I love it, Chris. Now, growth. What's growth for? Folks, what's growth for when it comes to the world of property investing? Well, growth, often many investors have growth, and it's like a safety factor, right? A safety factor of, it's going well. My property's grown in value, which is fine. Nothing wrong with that, but that's psychological. Your growth means nothing, folks. It's irrelevant if you can't use the growth. Okay, you can't use the growth. So what's the growth for? Put it in the chat. So if you buy a property for, let's say, 700 and it grows to $1 million, what's the point of that, folks? Tell me what's the investment point. And this often depends on what stage you're at when it comes to the world of investing. But if you're in the accumulation stage, you're in the acquisition stage, folks, what's the point? Your investment grows in value, right? And on paper, boom, Brad, on paper, you're wealthy. It's all about the equity. And more importantly, Brad, yes, okay, boom. More importantly, this is the one, the ability to leverage it and borrow more money. Now, folks, don't get me wrong, don't misunderstand this. It increases your wealth, totally does, Dean. The challenge is, Dean, I met with some clients the other day, huge amount of equity to refinance and buy more. Boom, exactly, Brad. I've met so many rich on paper, poor in accessible cash. Can't get the equity, no cash flow, right? So what's the benefit? There's no true benefit. It's all a paper exercise if you can't get access to the growth, folks. All right. So growth in the early days is for creating deposits for other investments. That in the early days, that's what growth is for. In the later days, folks, this is the cool part. When your equity grows significantly to the point where, your loan to value ratios are, sub 50%, sub 30%, you can use growth, folks. You can use growth and equity tax-free. Who likes those apples? Tax-free to live on into the future. Now, that's later on, but that's not now. Growth is for deposits. Remember that, okay? And later, it could be growth for deposits. Growth could be for a sale and debt reduction if that's part of your plan. Growth does not make you wealthy by itself. If you don't do anything with the growth, it's a paper exercise. It's what do they call that? I've heard this said, mental masturbation, right? It's a mental exercise, all right? Growth is for deposits. Get access to the growth, buy another property. Get access to the growth, buy another asset. That's the point of growth assets, folks. Okay, tax effective. We've talked about this before, but the point is, if you go and buy an asset that has no tax effectiveness, either tax deductions as you go, helping minimize capital gains tax, all of those sorts of things, then, those assets need to be, thought about. Okay, how can you make them tax effective? This is about keeping more of what you make, right? And for those in the world of PAYG, those in a job, residential real estate is the most tax effective asset you've got access to at this moment in time. Will the rules change in the future? Maybe not. Stop worrying about shit that you don't control or is just, a pipe dream. Take advantage of something while it's here and change your plan if you have to, if it changes, right? Tax effective. Keep more, folks, of what you make. The average Aussie who goes to work and works for 40 years on an average wage of 100 grand over 40 years, folks, they pay $3.2 million in taxes. 3.2 million, folks. 3.2 gone to the government. That's just income tax. That's not any of the other taxes that, GST and fuel excise and, council rates and all this other shit that they call, some other thing which is not a tax, which is a damn tax, right? A lot of money. So can you make that tax effective? Yeah, you bloody can. And you should, right? As you go. Leverage, folks, right? This is the magic trick. It's not a magic trick, right? If you leverage at 70%, 80%, 85%, 90%, the the value of real estate that you can purchase, is significantly more at 90% than it is at 70%. And the amount of cash you have, the amount of deposits you have is a lot smaller. Well, it's often limited. So that's what leverage is for. Leverage is important. I was talking about this yesterday, right? Go down to the Commonwealth Bank and ask them for a 90% loan on Commonwealth Bank shares and see how you go. See how you go, right? Not going to happen, right? Hey, morning, Fritz. Good to see you, mate. Not going to happen. So leverage, vitally important. Leverage now to purchase the asset up front. And folks, leverage later. This is so vital. And so many people miss this. If you don't have an asset that you can't use, that the banks won't use as leverage to lend you money, right? In the future, you'll have to sell those assets if they're not high income producing, right? You have to sell them and pay capital gains tax to get access to income of some description. And I think that's, for me, that's counterintuitive. You put all the effort in to purchase the asset. Keep the asset, folks. Keep the asset. Use leverage smartly. Anyway, so they're the four things: income, growth, tax-effective leverage. Don't break those rules, all right? Because let's just apply these simple conversations to the four types of assets that, by and large, we might consider in the world of being an investor, right? So property investing, property resi, so residential property, let's call it commercial. I'm just going to put it commercial, and that might be, industrial, that might be commercial, that might be retail. It might be all sorts of different styles of commercial property, in that world. Residential, house, townhouse, apartment unit, et cetera, et cetera. All right. So those sorts of things. Then you look at shares, the share market. Now, obviously, there's a lot more detail in this sort of idea. And then you look at business. All right. Business is a direct investment in business. These assets, right? So let's have a quick look at this. And if we have a look at all four, you go, all right. Well, if we're looking at all four, number one, does residential property create an income? Damn right it does. Fantastic income, very reliable. It's not a high income, but it's the most reliable income you can invest in, like anywhere, right? Number two, does it grow in value? Yeah, 100% it does, very reliably. Slower than other things. It's not fast, but it's slow and reliable. Can you get tax deductions? Boom. Can you use leverage? Boom, right? For me, for most of us, there's a big tick in every box there, okay? So if you go to commercial property, I'd probably give it a double tick for income, okay? I'd probably give it a half a tick for growth. Growth is different for commercial and industrial properties, and I'd probably put a little cross there, because if you don't know what's going on, if you can't maintain a property, a commercial property, then you've got some issues, okay? And there's vacancy rates and all sorts of stuff. Anyway, can you get tax effectiveness? Yes, you can. Quite good, actually. But here's the big one for me, right? Leverage. Leverage is way different. Under a commercial loan, you have no protections. It's not residential lending, it's commercial lending, it's business lending. You're out of the NCCP. You're not an individual anymore. You're a business loan. Those loans can get called in if the value of your commercial property goes down. The bank can call your loans in. Where residential, that will never happen. If your value of your property goes down, they can't call your loan in. So there's some differences there, folks. Some differences, right? So that's why I'm not a fan for beginners, and I wouldn't say beginners, but for those who want something simple, residential, done properly and done well, can tick all the boxes. For business owners, some commercial stuff combined with your business is very clever. Okay, let's go shares. Well, number one, yeah, income can come in. Number two, growth is pretty good. Number three, deductions. No deductions. Not in a real sense anyway, other than the interest. But you've got no other deductions over and above, which is what property is good for. And leverage, well, like I said, go down to the bank and try and leverage directly, standalone shares. It's not going to happen, is it? Okay, not going to happen, folks. All right. Now, business, yeah, great income, but can be a dog of a thing too if you get it wrong. Okay, can put you underwater pretty quickly. Number two, growth. Well, I'd put by and large, most businesses don't grow in value, and most business owners don't know how to actually take advantage of business growth, and that's another conversation, not for today. Depreciation, those sorts of things. Well, yeah, I'd give it a kind of a yeah, but nah. And leverage, you kidding me? No, and no. You can't get leverage off most businesses, and if they are giving you an overdraft, folks, just so you know, we've had this chat with a few of you. They're securing it on your own home, and everything that you own is at danger with your businesses, right? So for me, the easiest, simplest asset to navigate in the early days of investing is residential property. It goes slow, and those things. It's a kind of a 10 to 15 year minimum plan, but that's perfectly fine as far as I'm concerned when it comes to this stuff. So there you go, right? Leverage. It's important to understand those four pieces, team. Is it giving you income? Will it grow in value? Is it tax effective? And can you use leverage to continue to make the asset's value more effective? Okay, the effectiveness of what you've done as you go. All right, folks, that's it today. Wealth Coffee Chat done and dusted. Hopefully that was useful. Tomorrow we're going to dive into the tax bit. Remember, we got income, assets. I'm doing some air karate here. Income, assets, taxes, debts, and we'll continue to do the deep dive and peel back this stuff, folks, as we go. All right. That's it from me, ladies and gents. Wealth Coffee Chat done and dusted. Thanks for joining. Fantastic to have you here. Let us know in the chat if there's anything that you want me to cover. But always great to have you guys on this morning. There's Sonia. Morning, Sonia. Thanks, Brian. All right, folks, that's it from me. Enjoy the rest of your day. Thanks, Dean. Thanks, Brad. Thanks, Chris. Thanks, Jeff. Thanks, Alison. Whoever's there, Jared, Brian, Jace, Alex, whoever's still on. Thanks for joining, folks. Join me tomorrow. If you're hanging around and you want to do it again, let's do it. 8:10. You guys know the drill. All right. Thanks, Alison. See you, mate. All right, folks. Bye-bye.